Listen to me very carefully. What I am about to tell you is going to save some of you from total financial disaster, and for others, it is the wake-up call you desperately need to protect your legacy. I'm George Sterling. I've been in the business of capital for over 2 decades. I've seen bubbles form, I've watched them burst, and I can tell you right now with absolute certainty. We are sitting on the edge of the biggest real estate bubble this country has ever seen. And when it pops, and believe me, it will pop, a lot of people are going to lose everything. Right now, across this country, regular folks making $60,000 or $70,000 a year are buying homes for $700,000. They are stretching every dollar, taking on mortgage payments that eat up half their income, and whispering to themselves the world's most dangerous lie. Real estate always goes up. That is exactly what they said in 2007, right before the world fell apart. The math doesn't work anymore. When you strip away the FOMO and the emotions, you see a market completely detached from reality. Home prices have skyrocketed, but wages have barely moved. This isn't growth, it's debt. Massive, crushing debt. People are house poor. They have the biggest house on the block, but no emergency fund, no investments, and no cushion. They are one layoff away from being finished. At Prosperity Prism, we don't deal in hope. We deal in math. Today, I'm breaking down the forces that inflated this bubble and the single trigger that is about to bring the whole machine down. The signs are everywhere. The cracks are forming. The only question is, are you going to be ready or are you going to get crushed? Welcome to the bubble's end. Why is this happening? To understand the bubble, you have to look at the cheap money era that preceded it. For years, interest rates were kept artificially low, practically at zero. This created a frenzy. Everyone became a real estate mogul overnight because borrowing was nearly free. But in 2026, the bill has come due. The hidden force at play is the divergence of affordability. While home prices stayed at record highs, the cost of borrowing tripled. This has created a locked-in effect. Sellers can't move because they don't want to trade a 3% mortgage for a 7% one, and buyers can't afford to enter. The market isn't healthy, it's paralyzed. When a market stops moving, it doesn't stay flat forever. It rots from the inside out. We are now seeing the first wave of forced selling from those who over-leveraged during the boom. The systemic flaw is the appreciation addiction. The American public has been brainwashed to believe that real estate prices are a one-way street. But real estate is a cycle, just like any other asset. The flaw in our current system is that we've treated homes like ATM machines. People took out home equity lines of credit to fund lifestyles they couldn't afford, luxury vacations, new cars, and renovations, all based on paper wealth that can vanish in a single quarter. If your entire net worth is tied up in the equity of your primary residence, you aren't an investor. You are a hostage to the market. In 2026, the architect understands that a home is a place to live, but your wealth must be built on cash flow producing assets that don't require a 30-year debt commitment to maintain. The psychology of a bubble is always driven by 2 emotions, greed and fear. First, the greed of missing out drove prices to the moon. Now, the fear of being the last one in is starting to settle in. I see it in the data. Buyers are finally starting to blink. The psychological floor of the market is cracking. When people realize that their neighbor's house sat on the market for 6 months and eventually sold for 15% less than the asking price, the panic begins. The architect remains stoic. While the crowd is panicking, we are preparing. We don't buy when the sun is shining and prices are at the peak. We wait for the storm. Remember, wealth is made in the purchase, but it's realized in the patience. Now we pivot from the homeowner mindset to the capital strategist. At Prosperity Prism, we aren't interested in owning dead equity. We want liquid leverage. If you are sitting on a massive amount of equity in a bubble market, you are essentially holding a winning lottery ticket that you haven't cashed yet. The pivot requires you to ask a brutal question. If you didn't already own your home, Would you buy it today at its current price and current interest rate? If the answer is a no, then why are you still holding all your wealth in it? We are shifting toward assets that offer asymmetric upside, where the risk is low but the potential for growth is massive. This is the hallmark of George Sterling's portfolio. How do you survive a burst? Step 1. Stress test your debt. If you have an adjustable rate mortgage or a HELOC, you are in the line of fire. Fix your rates now or pay down the principal. Step 2. Build a vulture fund. Start accumulating cash in high-yield, liquid accounts. When the bubble pops, properties will go on sale for 30 to 40 cents on the dollar. You want to be the one with the cash when everyone else is desperate. Step 3. Audit your utility value. If you're living in a house that is too big or in a city that is too expensive, sell now while there is still some liquidity left. The last out is always the one who loses the most. The elite don't just wait for a crash, they profit from the volatility. The advanced play in 2026 is short-term liquidity arbitrage. We are moving capital out of residential, single-family traps and into distressed commercial debt or recession-proof industrial assets. We are looking for value-add opportunities where the price is depressed not because the asset is bad, but because the owner is broke. In the world of George Sterling, we don't pray for the market to go up. We position ourselves so that we win regardless of which way the wind blows. By holding dry powder, cash, you become the bank when the actual banks stop lending. Look at the history of 2008. The people who lost everything weren't the ones who didn't own houses. It was the ones who owned too much house with too little cash. The proof is in the foreclosure data starting to creep up in the Sun Belt and tech hub cities. Prices in Austin, Boise, and Phoenix are already showing the first signs of the red slide. In a bubble, the first 10% drop is a correction. The next 20% is a crash. We are currently at the edge of the correction. If you look at the price-to-rent ratios in major U.S. cities, they are at levels that have historically always preceded a 30% or greater decline. The numbers don't lie. To survive the pop, you must avoid the value trap. Don't buy the dip too early. In a real estate crash, prices don't bottom out in a week. It takes years. Avoid the fixer-upper trap in a declining market. Renovation costs will stay high while the end value of the home drops. Lastly, beware of seller financing deals that look too good to be true. Usually, it's a desperate owner trying to pass their bag to you. Stay disciplined. Stay liquid. Your survival depends on your ability to say no to 99% of the deals you see. This is where the architects are born. Legacy isn't built in times of ease. It's built during the great resets. When this bubble pops, it will represent the greatest transfer of housing wealth in a generation. You can either be the one losing your equity or the one standing ready to acquire the future. I'm George Sterling. I've seen this movie before, and I know how it ends. Don't let your American dream become a financial nightmare. Subscribe to Prosperity Prism, and if you are ready to survive the burst, comment Architect below. The bubble is thin. Don't be there when it pops. I'll see you in the next one.